Hello, Warriors. Hi, James. Michael Weissman, Kman. How are you, teammate? AJ, Ryan's here, and George. So why don't I start with you, Ryan? How are you?
Oh, good.
Good
You?
morning, buddy. So,
Morning, mate.
what do you think about cable failing rally? Is this just some type of little ABC, and that we're going to make another run, or are we headed back towards 125 again? Was that it for
Uh,
the pound?
it could be. I mean, you could probably highlight those highs and lows with events, Bank of England data points, whatever. This
Yeah,
morning we had inflation falling from 4.4% all the way down to 3.9%.
yeah.
Sorry, 4.6 to 3.9%. So a big drop in inflation, and then we've caught the cut. The BOE's caught the cut cold, as we say. It's now galloped up with the rest of the riders playing the rate cut race. So that's why that's been zapped this morning. Rate cuts now expected in May from whenever they were before. So in the same boat as everyone else now with rate cuts, and that's why the pound suffered.
Okay. Um, for a couple of weeks I was talking about 68 or so in Aussie, and Aussie almost got there.
Nearly, still might.
Yeah, yeah. So it's the strength. I mean, I don't know if you want to be short the strength, but you see this here, nothing, it's not profit till you take it. If you bought it on Ryan's number, that was down at 65.25. So, I mean, you have over 200 pips.
Yeah.
Okay. Dollar would have tanked 150 pips. LOL. Okay. Someone's in the holiday spirit. So, your take on the yen, I mean, it's trying to pull back from your level. We're going to run again.
I think I was thinking that yields, 10-year yields yesterday might have fallen through the short-term support and given this another driver. But it's had a run lower. It seems to be pulling up a bit in the low 143s now. So yeah, it's if tens go, this might continue on going in dollar yen. But it
Okay.
has come quite far since that test of 145 yesterday. So
Yeah, look at yields
yeah, just breaking
diverging.
below that. Yeah, the
Yeah.
last couple of weeks it's found support around that 389, 390.
Yeah.
I thought it might blow through, a quick drop down to 380, but it looks like it's grinding lower instead.
Okay. And when I moved to Kman, how are you, buddy? And
Hey, good morning, Dale. Good morning, everybody.
what are you doing? And I know you're trading a lot of crosses.
Yeah,
Still in that mode.
yeah. I'm still short EURAUD.
Okay, it's working.
I'm starting to look at EUROCAD as well, which could be something for year ends. Yeah, and the dollar is a bit of a question mark for me, really. I thought euro sterling was going to go much lower over year end, but then that inflation print had me a little skeptic. So I'm just waiting on that one right now. Cable looks a little fragile. This 126.25.30 and then 125.90 really should hold,
Right
or
here.
it may
Yeah.
be bad news.
Yeah.
And yeah, I mean, if you look at the yields, they're all coming down. I
Yeah.
mean, bond yields are coming down, yields are ripping, Aussie yields as well. I mean, it's the whole package is now they're putting down the whole yield environment. So it's a little tough for me to really find exactly what's going to happen. I mean, based on what went on this month, quarter, because we slowly going into that area right now, and that zone right now is we should still see a bit of dollar selling, but I'm not sure whether it's going to be paired with a lot of euro buying. I was hoping or thinking perhaps the euro could do that overshoot into the 110s, close to the 111, and then
Yeah. That's
side.
what I was looking for too.
Yeah, but and I'm already looking at the options because the volts are coming off, which is going to make it cheaper to take the other side perhaps. But perhaps next week, who knows? There's still a lot of water to flow in the bridges. We still have like 6 or so, 5, 6 trading sessions.
Yeah.
Yeah, so those are things I'm looking at. I'm not really tempted to do much in the yen right here and now. I'm leaving that to the new specialists, Ryan and Blake,
Okay. Yeah. Well, they learned so much from you. So
Right.
now you can watch them outperform you.
Yeah, okay.
Anyway, that's I always like
Yeah,
to see
well,
people outperform. I noticed something came in. I want your comment on this. You see this 4-hour Dixie,
mm,
and now look at the 4-hour USD one.
yeah.
If my hands would stop
They left their
shaking.
rates unchanged, but
Don't they look similar? Look at that.
uh, oh yeah. Oh wow, yeah. I didn't realize that.
Well, I just realized it when I was just when I flipped to the one. I go, wow, that kind of looks like the same pattern we're getting in the dollar.
Yeah.
Can you explain why it would trade so closely with the dollar index?
The biggest trading partners, I guess.
Okay,
or
that's a
or
good one.
has been at least, or wanting to be again. But there's a bit of nervosity going around again surrounding that Xi Biden thing,
Oh
saying
yeah,
the
he said he
Chinese
was
want to
gonna.
reunify after
Yeah,
all. That's going to where I thought that 2024 may be. I'm not saying recoupling, but maybe somewhere where China, we've gone through the worst, and then perhaps investors are going to get back into China. If Xi is starting to talk like that, I think the investors will just leave it, and I don't think that the Chinese yuan is because to strengthen you need inflows. It's not just because you're through the worst that all of a
right.
sudden your currency is going higher. You need flows, right? And you need
Yeah,
inflows into China. But
right.
if she is going to continue to play the geopolitical game, those investors may say like, well, hang on a bit, we are perhaps going to wait. And then you're still left with a government that is injecting money in the system and the PVOC as well, watering down the finances. So I'm not so sure now that I really want to be making of the Chinese yuan my trade of 2024 or one of them. Not so sure right now.
Okay. Silver hanging in there pretty tough.
Yeah, hang in there.
Gold, same thing. So I've seen some counts where, we could rally up to here in gold and that would finish B and then we get a C. So, and silver could trade, I don't know, 24 and a half or so, 25, and then we get one more break into early next year, February, something like that. But so, I wouldn't short it,
Mm.
wouldn't
Well,
short.
you know who you should ask, and good morning, guys. You should
Ooh,
ask Stelios Contagoulis, who happens to be here with us.
Hello, good morning.
okay.
How are you?
How are you, Stel?
I'm very
So
well.
you have levels in silver. I know you held
But
your longs from the spike up here. Uh, we had it
yep,
right back up there.
25 and a half is the level, really. That's
Okay.
going to be resistance, if it is resistance. And on the downside, those lows there, 22.50-ish. But in between, we're just ranging for
Yeah.
my kind of trading, right? I'm not a day trader. I don't look at 10-cent intervals or levels. So that's what I think now. So we are ranging. The problem that we have is that gold did that false breakout. But as I said before, there's a reason why gold got to new all-time highs. And I think that, multitude of reasons actually, but I think that that move to all-time highs was a genuine move, and I think it's going to get retested. And the problem that we had with gold was that a lot of the fast money just got very long, and all the shorts got stopped out. So the market got one-sided very quickly, and now a technical false breakout means that we're gonna see maybe even lower levels from here, but this is the correction. And if you scroll out, you look at the weekly charts. I've said this
Yeah.
over and over again. Look at what gold's done over the past 2 years, where we've had tightening, QT, hikes, everything. It's been supreme, supremely stable. I mean, it's still within a channel. Yes, a pretty broad channel, but it's done very well. So my thesis is still very bullish. But in the short term, would I be buying it up here? No, I would be buying pullbacks or a breakout, another breakout to new all-time highs. I think it's going to be the big one. For silver, I'm long from 23.20, and I'm gonna add if we get close to those previous lows, which are around 22.5. We'll see. It depends on price action. It depends on PCE tomorrow, and see how things go. But overall, I'm still constructive.
There's your gold silver ratio. Wow, what a range. Look how many tests it's had up here still.
Yep.
87.5 and backed off. Really keep
S-
hitting it here.
78 to 87.5 is a very, very clear range.
Rectangle?
77.5, whatever it is. Yes,
Yeah.
exactly. So until that's resolved, I don't think there's any direction,
Yeah.
any clear direction yet.
I
So
agree.
I am tempted, I am bullish, but I will not get in it at levels which are not favorable, but there's no reason for me to get. It's difficult to be patient and to not want to pull the trigger, but we have to be patient.
Yeah, that's many months. I mean, that goes
Yes.
back to April
Yes.
of this
And
range.
the other
Yeah.
thing which I still have very strong conviction is yields, and I still think we're going lower.
Do you have a
And
level where you think it might stop? 10-year?
330 is the big level. 325 to 330 is that area, big support. I think we're going to test that. The question is what happens in the global economy when we get there, or when we get close to there. If we do get a recession, like a proper recession in the US, or in the Eurozone, etc., I think that's going to break. And remember when yields were at 450 to 5%, where I was saying,
Yeah.
I think we're topping here, and I was talking to people who are not traders but who are in markets, and they were all saying, 5% or 4.5% in 10-year US. This is really attractive.
Right.
Well, that was one thing, and now we've also got obviously the possibility of rate cuts, and the possibility of a major downturn in global economies. So that's all contributing. Plus the fact that the CTAs and positioning was very, very short. Treasuries, CTAs have done very, very well. So they're getting out now, and but they're not done. So everything conspired for us to have lower yield levels. How much lower do we go? I think we test 325, 330, and then we reconsider the whole global environment to see where we're going from there. We might bounce, we might not.
It's interesting. Joseph Wang, Fed Guy 12.
Yeah.
I said, do you think it's possible that we have a similar scenario to the 70s where Burns tightened and then he paused and then he had to tighten again?
Yeah.
And actually, Joseph is looking for new highs in yields in 2024.
I think
That
new
would,
highs are going to come, but I think that not that quickly, because I think we're going to get into a rate cutting cycle. So it's going to take some time. I have a friend who is he used to work at the investment banks, very, very smart guy. He sees 150 for 10-year US, and that's scary. And he's been right on a lot
that'd be a
of
recession.
things. Yes,
Wow.
exactly.
Yeah.
And then he
150.
says we're going to get to 150 to 2% somewhere there, and then we go shooting back to new highs. And that's a scary trajectory if we do get that.
Yeah. All right. Well, nice input. You've been following WTI at all still?
Trying to, but as I've said many times before, I really can't trade this. I really can't. It's just I can see a very big support area around 60 to 62 to 65,
That's
but
here.
I really have no idea, on WTI.
Okay.
Obviously, if we do get a recession, there's going to be downward pressure. So if you ask me what do I do here, I think I sell it on the way down towards 62 to 65, but I don't know. I don't know.
Does gravity exist?
Um, well, we're in December. Also, CTAs had been very short equities as well as bonds, so there's a lot of short covering.
Oh
I think
God,
we continue. I think we continue. I think we might squeeze up towards 5,000. But
okay.
then the potential of a recession and growth kind of collapsing uh, is eventually going to be bad news for stocks, because not everything can be good news for stocks. Initially, when rate cuts are being priced, the markets get happy. But after that, we realize, oh, okay, there's going to be a recession, so people losing their jobs, etc. So that's not good for equities. So eventually, we're going to go lower. Would I short it here? Absolutely not. Um, Difficult to find levels, really difficult
Yeah.
to find levels when you're at all-time highs or close
Yeah.
to.
When you're running like this,
Yeah.
yeah.
And it's non-stop, right? It's how many days? It's like 10 days, 10 trading days straight of upward action. That shows you that this is a lot of positioning, squaring, and short covering, and basically people trying to fade this move and getting stopped out all the time. That's what I think it is.
You have looking ahead into 2024, Stel, you have a favorite currency play that you're looking at?
I like commodity currencies, even though that doesn't go well with a potential recession. But I think commodity currencies have been very undervalued. I am still
Yeah.
bearish the dollar. So I'll be looking to buy dips, sell dollar Norway. That's been going down recently. Buy
Yeah.
Aussie,
Yeah.
maybe Kiwi too. The Aussie is
Okay.
actually edging towards some pretty big levels, but we're not
It
quite there
is.
yet. Yeah.
Yeah. 68. I had I think some weekly, maybe it was 69. I don't
68 and a
know.
half to 69, somewhere around there. I have to check my charts again, but we're edging towards some interesting levels. And dollar Norway, I've talked about quite some time. It's been very resilient, but now we had a double top around
Yeah.
11.25. And that's really had now an impulsive move lower, and I still like that to the downside. Targets, first target is around 10, which is nice round number, but
Yeah.
after that, trap door opens, and I don't know, it's anywhere between 9 and 950. So we have to keep an eye on that.
Yeah. I remember here I was looking for one more high for a 3,
Yeah,
and it never happened. It happened instead in Canada, had a pretty classic 3 up here. Yeah, it shows it on the daily. This was pretty classic here. 1, 2, 3.
absolutely.
Right,
Yeah,
so yeah, they look pretty bad. Well, I mean, commodity currencies look pretty good.
yeah.
So, Blake, it's time for you.
What's
How are
happening,
you?
guys?
Yeah, what's going on holiday
Ha-
weekend?
Happy hump day. Happy hump
Yeah,
day.
yeah.
Well,
What do you?
FedEx is down. Huge. It's huge.
Why?
Well, they
They missed,
warned.
obviously.
I guess you can start off by, they had their earnings call, revenues hit. They lowered their full year sales outlook. So, I mean, FedEx is just getting crushed. It's down like 10, 11%. What's up?
I was going to say, don't people usually look at companies like FedEx and Caterpillar for
Yeah,
growth?
Yeah, it's kind of like that canary in the coal mine type of thing,
Yeah,
right? So if you look at FedEx, I mean, here we are, we were just trading at, what is that? I guess it would be near all-time highs. I mean, I guess we're a little off, but you can see right now pre-market we're down almost 11%, 10, 11%. So they're, you know,
Wow.
their earnings fell short. This is like the second quarter in a row that they've warned. And let me see if I can get a comment here. So they're here. In the remainder of fiscal 2024, we expect revenue will continue to be pressured by volatile macroeconomic conditions, negatively affecting customer demand for our services across our transport companies. So that's, you know, I mean, and I guess that was like their second quarter in a row that they're warning. So, you know, when you see things like this, it is that kind of that canary in the coal mine. However, I have to say this. I mean, you know, we're not too far off of all-time highs. The Nasdaq's failing at the highs, and I know a lot of people are the first thing that comes out of their mouth is double top. It's not a double top. It's just we're at resistance. We're at really critical resistance here on the Nasdaq 100. You can see us, you know, probing it. But you know, if we can shake off, if stocks can shake off this news today, I don't think you want to be on the short side of equities. If you can see S&Ps just claw back whatever, you know, little intraday losses that we're seeing right now at the open, if we can just continue higher and stay above 4,700 on the S&P, I would not want to be short equities. But anyway, that's like the big news overnight, kind of, you know, it's got some people worried. Then you got the, you know, obviously yields globally are falling, you know, and I think that's a point that, you know, Kman and Ryan were talking about a little bit earlier. I mean, yeah, you got the sterling breaking down today or trying to break down. You know, we had weak UK inflation data. And how do you feel about that, Ryan? I mean, you know, you got inflation data coming down, sterling's getting hit. Do you think that this downside pressure is going to sustain in the sterling? Because it's breaking down. It's the pound's breaking down against a lot of things. You got the pound Aussie, nice breakdown. Range extension should take us a lot lower, actually, especially against these commodity currencies. Kman's been calling commodity currencies to rally against the euro and the Aussie, and that's definitely happening. I mean, but how do you feel about the sterling at current levels?
Yeah, well, it's reacting to the inflation data. The same, you know, if it was a strong piece of data, we'd probably be trading 128. So yeah, you know, does it mean this is the end of the rally for cable? Most certainly not, because you know, you get a soft piece of US data and cable's back at 127 again. So really, the pound's making a bit of an adjustment today on that inflation data, obviously with increased rate cut expectations now, the same as everyone else has gone through. So, you know, watch levels. Unless we're under 125 or something like that, then no, cable hasn't broken yet. The pound hasn't broken yet. It's just having a little adjustment period, shall we say.
Yeah, I guess we're getting a lot of that in different markets. You know, just that's kind of like part of holiday trading. When you're looking at the sterling, and I just want to point this out really quick, we are at and we're really kind of struggling around this 618 retracement. It comes in at 127 and change, and we're really having a difficult time around here. We're above it, we're below it. You know, it's technical analysis, as you often hear me say, it's not an exact science. You know, if it was, we'd all just absolutely crush the markets. But you guys know the markets don't work like that. So you can see we're you know on both sides of this critical 618 retracement on both sides of it by 20, 50 pips or whatever. So I think where we close the week probably is going to be pretty important. But overall,
it's the same as the euro dollar. When euro dollar came off 110, everyone was going, "Oh, that's it. That's the top in the euro. It's heading back to 105." Yeah. And I said, you look at your fibs. That's your judgment call for whether a trend is breaking. And the fibs in euro dollar hit the 50 fib of that move up from wherever it was, 104.50, whatever it was, and it held. Cables in the same boat. It's come off the highs in the 127s, but it's still maintaining the rally that it's had from 120.50.
25.
The 50 fib comes in at where I haven't even got it on my chart. I don't think. Where am I? I need to measure it. I haven't got it on there. But we haven't tested the 38.2 fib of the move from October 120s to 128s nearly. So yeah, the trend isn't broken, not by a long short.
Yeah.
Short.
Right. And you know, I picked up some euro on Friday, and I spun out of it yesterday up in the 50s here because I figured we're developing some sort of like, you know, cup and handle pattern. That's what I think, and I know I mentioned it here yesterday. But in the meantime, you know, we might have this little bit of a triangle, and that's kind of what's happening. I'm assuming now tomorrow. I would think that this consolidation continues to take place, you know, maybe through well, it looks like today we have consumer confidence today. Tomorrow we have GDP, unemployment I can't even speak. Unemployment claims, Philly Fed, and then you know Friday is going to be PCE. But I don't think that we're going to be able to hold out in a really tight trading range between now and Friday. So what I'm thinking here is between, you know, you got sterling, euro, we're going to be breaking one direction or the other, probably going into tomorrow's data, I would think, just by time and, you know, what we're seeing develop here. But, you know, we'll see. I doubt consumer confidence is going to move the market too much, although you know, consumer confidence has been stronger and it still is, it's expected to actually tick higher today. I mean, the US consumer is still, you know, robust and vibrant as far as I can tell, from where I sit anyway. So it's going to be an interesting data piece today. You know, you asked Dale a little bit about crude, and when Powell gave his pivot on Wednesday of last week, you know, I jumped on the trade-off show and I'm like, this is the trade, you know, you just buy crude, and crude is, you know, rallying and right into a descending trend line here at $75. If we can break that $75 level, we should, challenge the 200 DMA, the 50 DMA here. But what do you guys think that's going to do to consumers globally if you start to see energy costs really ramp up into the beginning of this next year? I mean, are you guys going to feel it in Greece? That would be you, Stelios.
Of course, won't we?
How's that going to affect the Greek economy that's absolutely
The Greek economy is
ripping balls
booming
over Germany right now? So
yeah. I just hope we have a nice warm winter like last year, because the bills are going sky high.
Yeah. How are energy costs? I'd love to, you know, tell us a little bit about what you're feeling there in Athens, but then I'd love to hear what energy costs are like in the UK afterwards. So, how are you feeling there in Athens right now?
Well, energy costs, natural gas has dropped obviously, but as with pretty much everything, same as the fuel at the pumps, it doesn't drop in line. You know, when the prices rise, they go straight up in our bills, but when they drop, they don't drop as quickly. So it's still a big chunk of the average family's income, you know, energy costs. And unfortunately, I don't see it dropping much more from here. But I don't know. I don't know what to say. What's happening in the UK, Ryan?
Yeah, what's happening in the UK? How have energy costs, have they fluctuated quite a bit?
I don't know. We're still lighting the fire with £50 notes. You know, it doesn't bother us over here. But no, prices are going to go up in January when they move this price cap higher again, which I can't understand, because if you look at gas prices, wholesale gas prices, they haven't really jumped up. So I don't know what these clowns are doing, ripping us all off by the looks of things, as per usual. And but yeah, we'll get an inflation jump in the new year. Probably the Eurozone will as well. So I expect those inflation numbers to pick up a bit, as a lot of the central bankers have been predicting.
Yeah, and that's going to be a big problem. Dale, I know you were having this discussion when we first started the F.A.C.E show. I think that's going to be a big problem going into the first quarter this next year. And I bet Peter Bookvar, when he comes on in a few minutes, he's going to have a lot to say about central banks and where inflation's at right now versus where inflation's going to be at in the next couple quarters, and how the Fed and other central banks are going to have to react to that. It's going to be interesting. I think their Achilles heel is going to be energy costs, and I think that's going to be we're seeing deflationary data, kind of around the globe, but that's eventually going to feed into probably weaker earnings moving forward. So it's going to be a really interesting 2024, in my opinion. I think there's going to be a lot of moving parts, and I think there's going to be a lot of divergences in central banks, which is going to make for a really fun volatile party for traders in 2024. But that's what I'm looking forward to. And Dale, I know you have Peter Bookvar here, so I want to pass it over to you, but I want to say, first of all, thanks, Stelios, for being here. You going to be here the rest of the week?
Probably, yes.
Awesome. Oh, good. And Kman, it's great to always have you here, and Ryan as well. How are you guys enjoying not doing the flow show this from here on out today?
Yeah, loving it. I wish I could say I was enjoying it. I've had my head in some paperwork that I had to catch up on before year end. So, yeah, not much fun. I'd rather be doing a flow show, I think.
I already miss it.
You do. All right. Well, hey, the good news is we have you in the ForexAnalytix community, and you could always be a sounding board there, and as we love having you there. So, all right, guys, I'm going to pass it over to Dale. Dale, thanks for having an interview today with Mr. Bookvar. We're excited to listen to Peter, and it's all yours.
Thank you, team.
Thanks, Coach.
All right. Thank you, Stel. Nice hearing you today. Peter, welcome back to F.A.C.E. How are you, buddy? Yeah, can you unmute?
Can you hear me?
Got you now, Peter.
Thanks. Sorry about that.
That's okay. Welcome back to F.A.C.E, Peter. Here we are, almost another year in the books. I'm interested in your look ahead for 2024. What's top of mind for you going into a new year, Peter?
I'm still focused on how the economy continues to acclimate to this higher rate environment. Obviously, 2022 was the rate shock. 2023 was the celebration that while the Fed continued to hike as the year progressed, they were slowing down the calibration of those hikes and obviously eventually stopping. But I do think that a lot of the aggressiveness with respect to those hikes are still working its way through the economy. And every day somebody's loan is coming due. In 2024, we have about $700 billion of investment grade bonds that need to be refinanced. You got about $500 billion of commercial real estate loans that need to be refinanced. But even if the Fed cuts interest rates next year, which they will, I just doubt it'll be as aggressive as the market expects. Even if they cut to 4%, which is what the Fed funds futures market is pricing in right now, that's still a far cry from zero. And it still means that there is still a refinancing reset that's taking place. And, the economy is globally challenging to begin with. And that's not coming from me. It's coming from about every single company that reported earnings over the past 2 months. They said it themselves about a challenging macroeconomic environment.
Yeah, was FedEx today or UPS today?
FedEx, you had General Mills in their earnings release that's obviously selling, pet food and cereal, talking about a discerning customer. You had Accenture yesterday in their earnings call talking about, more a slower decision making taking place in terms of projects. But it's something that we've heard throughout.
That's something about pet food, Peter, because people will treat their dogs better than their relatives and even themselves. They'll go hungry so their pets can eat. So
what's happening in the pet food business, and I know this because we're involved in a stock that we own, is that you still have to obviously feed your pet every day, but the consumer is going to the more value type food,
Back to the
whereas before they might
pellets.
have been buying premium instead. So
Right.
they're buying, Purina
Right.
instead of the higher end stuff, and they're buying less sort of supplies or toys when they go
Okay.
to the pet store or ordering online. So they're still obviously caring for their pet and feeding it. It's
Yeah.
just not to the extent that they were beforehand.
Yeah.
But that's what we're seeing.
Well, that
In a
tells you they're
variety of different
stressed
hotels.
if they're looking to save in an area like that. That's my takeaway from that.
Yeah, there's no question. I mean, we heard from Walmart and Target and the dollar stores how consumers are still prioritizing their spend. They're being quote unquote choiceful. I heard that word used a few times. I didn't even know it was in the dictionary
Yeah.
about how consumers are spending. And then on
Okay.
the other parts of the economy, you have manufacturing that's in a recession globally, and FedEx, confirmed that with their earnings release. You have the housing market that's sort of backwards, where new builds for the bigger home builders are doing well. The smaller builders can't get financing, and the existing home market, is in the doldrums. So it's very, very much a strange economy. You have the higher end consumer that continues to spend. They're
Yeah.
benefiting from both having jobs and collecting 5% interest income on their savings, whereas the lower income person, while they've had some nice wage gains, they're dealing with the cumulative effect of a 20% rise in inflation over the last 3 years and concerns about that.
Okay. I know you're a China watcher, and G was here. We heard what he talked about a little bit with Biden, but I would think that you'd be licking your chops at how cheap China has gotten with the U.S. market, almost in a parabolic move to the upside. Do you think it's China could end up being a nice recovery play in 24?
My 2024 call is the Hang Seng outperforms the S&P 500,
Oh,
and I've said
nice.
this
Okay.
multiple times. I was at a conference in November, and I made that case. I
Okay.
think that's going to be so. The thing with China is, you need to pick apart what's going on over there, and their manufacturing sector is dealing with the same challenges as the rest of us. Consumers are obviously switching their spend from goods to services, and also the inventory destocking, which I think has pretty much run its course. There has really been no signs of restocking, and FedEx actually talked about that in their earnings call last night. With respect to the China residential real estate situation, yeah, that's in a really distressed situation. But
Yeah.
China is at least approaching it, I think, the right way, in the sense of forcing a lot of bankruptcies upon these developers
Instead of
and trying
QE?
to cleanse the system. And
Okay.
cleansing an overheated system is always a painful process.
Right.
Then you also, of course, have the leverage on the bank balance sheets and local government financing. So there's still a lot of challenges in China, but it just has to be less bad. And I think the Chinese consumer, another year, will be distancing themselves from the PTSD of COVID. And there's still a large pile of savings there, even though real estate wealth is being compressed with what's going on in that part of the economy. But I think there's enough all in to make it less worse. And
Okay.
that is all you need to see an improvement in their markets.
Okay. Why Hang Seng over Shanghai against the S&P?
I think, well, there are Chinese stocks that trade there. I think that it's
A more liquid
a
market.
cleaner way of basically saying let's buy the H shares instead of the
Okay.
A shares.
Got it. Okay. All right. So, how about energy, Peter? Are you worried about what's happening geo-wise in the Red Sea for supply chain issues with WTI?
So it's always something that we have to obviously worry about. You wonder though whether the U.S. and I forget who. I guess it's probably the EU that are putting forces in the Red Sea to try to create a safe space for a lot of these ships. I want to believe that there's not really going to be the supply disruptions that cause a problem. I think that stabilization in China, or being less bad, as I said, will be enough to lift oil prices. I still think that U.S. production has saved the day this year in terms of bringing enough supply to the market. But when you look at a chart of the U.S. rig count, it's done nothing but go down this year. And the reason why U.S. oil production has done as well as it have is just because the efficiency of these existing wells. But you just have to wonder, how much longer can we sustain such a high level of production with the rig count going down every single week? So I still like energy. We've been more in owning the European energy stocks that have outperformed the U.S. ones, just because they've been so much cheaper, and that still remains the case. And I think down to $2, you got to be buying natural gas hand over fist.
Okay, and here we are. So, okay, there's your spot on that gas. So is it weather market you're looking for, or is it the arbitrage between us and Europe that makes U.S. nat gas attractive down here?
It's never easy to bet on the weather. I think it's and it's happening in shale spots around the country. It's just depleting wells that just aren't producing, to the same extent, and that there's just the natural sort of degradation of a lot of these wells that, while initially very productive and prolific, sort of wear down. And I think that's the case in a few different shale basins in the U.S. And so when nat gas gets to around 2, you look at a chart, it's been a pretty good spot to add.
Okay, yeah, here we were. I actually thought we had a breakout here, Peter. Came out of a saucer bottom. Maybe we have to base again down here, or even like maybe a panic under these lows.
I mean, we'll see what the winter weather is like. That's always a wild card. I mean, last winter Europe had was given a gift with warm weather. I would have to believe that this winter is going to be cooler than last, but they're also well supplied. So we'll see. It's always, I never like to bet on weather. I'm looking more big picture on a multi-year time horizon. That
supply side.
That's my focus right now.
Okay, and do you think that this bond rally is a long-lasting move that could stretch higher, or was this just maybe some short covering and we head back down again? Did this bond rally surprise you?
Well, you had a couple of things. So basically, the 10-year yield is back to where it was in late July, where it took off. And remember, late July was when the Bank of Japan widened yield curve control. That, to me, lit the fire for the rise in interest rates. And then, as the months progressed, you had a slowdown in European CPI. You had the Bank of Japan in subsequent meetings saying they're not looking to change their NIRP policy anytime soon. You obviously had the Fed backing off, all combining for this big rally, but just takes the 10-year yield back to where it was about 6 months ago. I do think that bigger picture, there's still challenges on the long end. Short end yields certainly have topped. I mean, the Fed will start to cut, and I still like being in the short end, but the long end is still dealing with these big picture challenges of, at some point in 2024, the BOJ will get out of negative interest rates. We saw the October tick data last night, where the level of foreign holdings of U.S. Treasuries is back to where it was in July 2021. That's even after the U.S. Debt and marketable securities has gone up 4.3 trillion. So the foreign holdings of U.S. Treasuries continues to shrink. Fed's still doing QT. Banks are still reducing their allocations to Treasuries. So I still think you have this supply-demand imbalance that is going to rear its head again.
Okay, so it may not be because of inflation. It could just be no demand for all the supply coming to market next year. that I know I was talking to Fed guy, and because I think there's a chance that could we have a repeat of the 70s, Peter, where we tightened. I think it was Burns, and then he thought we were uh, inflation was handled, and then it reemerged, and they had to go back on a tightening campaign again. I think it was 3 times, and Volcker was the third tightening regime during that decade in 1979. Could we end up seeing over 5% yields in 2024 wherever they, pull back to? I know some people are talking, big moves. Some of,
Yes, you can, because there are a bunch of different dynamics here. The Fed starts to cut interest rates aggressively. You can see the dollar fall further. That can
yeah,
raise input prices. That can raise the price of oil.
right,
Looking out over the next couple of years, higher interest rates does impact negatively the demand side for the economy, but it also affects the supply side. I mean, right now, you take the multifamily part of the economy, and because rents are the biggest chunk of CPI, there is a huge amount of apartment supply coming online in 2024. Those are the buildings that were started a couple of years ago when money was easy.
yeah,
So rental declines will take place in 2024, but there is very little new multifamily construction beginning right now because these deals don't pencil out. So
yeah,
2024, we're going to get a flood of apartments. 2025, there's going to be a dearth of apartments. So rental growth will decline next year and inflect higher in 25 and 26. You take the transportation sector, the manufacturing recession is knocking out trucking companies left and right. So over the next year, if the economy continues to slow, you're going to see a lot of trucking capacity come out of the market. And at some point, prices are going to firm up, and transportation prices, after having collapsed, they're going to inflect higher again. So we're damaging the supply capacity of the economy just as we're negatively impacting the demand side. So you'll get a temporary cooling of inflation, but an eventual increase at some point, maybe second half of 24 into 25.
okay, because supply is not expanding because people are pulling in their horns, and
Yeah.
also and the interest rate scenario, like you were saying, a lot of things
Well,
don't pencil
that's
out.
it. Yeah,
Yeah,
exactly. So you're going to get, I mean, look at office, which is obviously depressed. Well, you can be sure for the next 10 years, there's going to be very little office supply.
right.
Look at looking at the shopping center business or the big malls.
Yeah,
Has there been a new big mall built in this country over the past 5 to 10 years? You can probably count on one hand. So the mall operators have pricing power because of the last 10 years of excess. The shopping center guys have pricing power because of the last 10 years of excess, where there's just no new supply. So that sort of lays the foundation for an eventual acceleration of inflation. But at least for now, we're going to enjoy the deceleration of inflation until those other factors kick in again.
maybe by mid-year we start seeing that stuff, Peter.
I would say the back half of 24, because you're still going to have a further deceleration in the rent calculation as
Okay,
it plays catch up to what's going on in the real world. I mean, there are apartment landlords out there left and right that are offering concessions. There is definitely going to be a depressant on the rent side of inflation throughout 2024. Question then is, which will keep a lid on services. But on the other hand, you have wage growth that's still probably going to be 4% next year. And that will keep a floor under other service parts of the inflation stats. And then we'll see what happens on the good side, where we're sort of back to zero on a year-over-year basis, which ironically was the pre-COVID trend in core goods prices was zero. I don't think structurally it stays here at zero. We'll see whether it ticks up again, but at least for now, it's at zero.
okay. I know you've been constructive on precious metals for a few years. Looked like we were going to have a big breakout here in gold, and I don't know, they were able to turn it back, but I don't think this is going to be a long-lasting high. You have some upside targets in gold and silver. I know
When
you don't
you
like to
look at,
trade it. You don't want to get, you would use the term, well, I'm not going to trade it. I'm not going to get cute and then
well,
miss everything. I do that though.
that's, yeah, well, that's for sure the case. I mean, when you look at how well gold has traded over the past 2 years in the face of
Higher
such
yields.
huge aggressive, I mean, we're talking about a real rate that went from minus 200 basis points to at its peak this year, plus 250 when you look at the 5 year, and the strong dollar, and gold was up over those 2 years. I mean,
Yeah.
what an performance. And now you give me lower rates and a weaker dollar.
Yeah.
I mean,
Tailwind.
I don't know what's now in the way of gold
I
on the
don't
upside.
either. And you know what? Either do the miners, Peter. And they've been underperforming for quite some time. I noticed on the last pullback in physical gold and silver that they barely took anything out of the miners. Are you warming up to them? And
So
maybe in different countries?
yeah, no, we're long some of them. I think the problem with being a mining shareholder over the past 20 years, there are few other forms of masochism. It's probably the worst business that you can possibly decide to enter. And that's been reflected in the performance of a lot of these companies over the past 20 years. But I do think that there's been a level of efficiency and religion that these CEOs have taken on. And
Yeah, they
that,
used to have a lot of debt. They carry massive debt. That's what killed them.
yeah, but
But
now the balance sheets for the bigger ones are much healthier. They're
yeah,
generating very healthy
here's
cash flows.
here's one with no debt that actually pays a 4% dividend, 4 or
When,
5%.
when you have 1,200 all-in sustaining cost, and you can
Yeah,
sell your product for $2,000, you're making a
yeah,
pretty fat profit margin. So
yeah.
I think there's a party to be had for these miners to the upside, as they are
Okay.
nowhere near close to pricing in a sustainable $2,000 price of gold.
Look at where they used to be.
I mean,
Okay.
the GDX ETF was twice the
Here it is.
price the last time gold was
Yeah,
around these levels.
yeah,
Now,
it was
granted,
56.
their cost structure was lower then, but um, there's a lot of cash flow being driven by those that are pulling the stuff out of the ground.
Technically, I just noticed it's a big symmetrical triangle that goes from 16 to 44. That's $28. So if we ever get a 36 breakout, it's going to give you 64. So back above the levels from 2011 could be in the cards.
I think we're going much higher in gold, and silver is going to follow.
Okay. Is there ever going to be gravity in the S&Ps? I mean, we're only a layup away from new all-time highs where we have it in NASDAQ. Are we just going to be parabolic? I've talked to people who said this is the last phase of this, you could call it a 40-year bull market from 1982 if you go back that far. And you've been in the markets long enough to know that normally abnormal things happen near the end of a bull market. That's when the biggest moves, parabolic moves happen. Do you think we're just going to keep blowing off and headed towards, I think you said earlier you could make a case for 5,100. Is that what you said?
No, I never
Oh, okay.
made that
All right.
case. I
So,
mean,
so what do you think? I mean,
so
here's the
in the very short term, technically speaking, you have the S&P, the 7 and 14-day RSIs are the highest level, and the other day they were the highest level in 3 years, and yesterday they might have even exceeded that. You have
yeah. Here you
the
go.
AAII and the II numbers pretty extreme. You have the CNN Fear Greed Index that went into extreme greed. Um, there's a level of giddiness there that, at least in the short term, will probably make it tough to see much further gains. And then you always, the market's not going to just slice through its record high. It's when you get to that record high, the people that bought the previous record high, they say, oh, now I'm back to break even. And so there's going to be a level of resistance here. The problem with the market is that it's just very expensive again. Trading at 21 times 2024 earnings. There's no, when you get to these multiples, there's no room for error, and rates are not zero anymore. When you look in the 2010s, I'm sorry, the 20s, the 10-year yield around 4%, the PE multiple was about 17.
Yeah.
A 21 multiple, I can understand when rates are zero, but rates are far from zero. So I think the market is grossly overvalued. So that's the challenge that it has. At the same time, earnings growth in 2023 was zero. Earnings growth in 2024 is right now, currently, I believe, well overestimated at about 10 to 12%. Nominal GDP with slowing inflation is just not going to grow fast enough to generate that kind of earnings growth. So you're going to have a multi-year period with no earnings growth, still high interest rates, and an egregiously overvalued market, at least for the bigger cap names. Now, the smaller cap names, definitely cheaper, no doubt. International markets, much cheaper, no doubt. I'm talking about the names that dominate the S&P.
Mag 7.
They're grossly overvalued in a mediocre earnings story. And even those names, their revenue and earnings growth have become much more pedestrian.
Okay, so with your call for a weaker dollar, and I agree with you, even though I think from 101 we could have one more dollar rally, but not above 105. Should we be looking at emerging markets here, Peter, with the dollar? That could be in for a prolonged bear market that takes it, into the 90s, maybe 80s. What would be your favorite markets outside of the U.S. in 24?
So I'm very bullish on emerging markets. I told you about the Hang Seng. We're long Singapore, Vietnam,
Asia.
Even Japan, which is obviously not a developing market, but still will benefit from an improvement in the region in Asia. We're long some Chinese stocks, or beneficiaries of, like Macau casino stocks and some other names, and very bullish on local currency emerging market sovereign bonds that pay a good yield, that I think can have that currency kicker. So I think EM managed the last couple of years rather well in terms of inflation, because their central banks never went down the rat hole of zero rates and QE, and were pretty aggressive in raising interest rates. I think it was the Mexican central bank, the Brazilian central bank, they started hiking in early 2021. The Fed didn't hike until March 2022. So I think the bonds of these countries and the currency exposures is pretty attractive.
Yeah, I mean, the peso has been strong for a while, even when the dollar was strong.
It's been tremendous.
Yeah, so here's Mex. So still looks like, wants new lows, which means a stronger Mexican peso. And, they also talk about, and we'll wrap it with this, all the reshoring of our industrial base. Mexico's a big beneficiary of that. A lot of people bullish Mexico, Peter.
Yeah, so Mexico's certainly been a beneficiary of even the Chinese that are building factories in Mexico, no doubt about it. So there's still globalization. It's just shifting to different parts of the globe.
All right, a quick comment. It's an election year. It's going to be crazy, isn't it?
Yeah, there's going to be a lot of vitriol and a lot of noise.
Okay, but we shouldn't worry about it. We should just turn the volume down on our TV.
Yeah, it depends on what level of torture you want to give yourself. There's certainly going to be plenty of entertainment involved. There's no doubt about that. But there's going to be a lot of cringe-worthy moments.
Okay. Well, the moments we spend with you, Peter, over the last 6 years, it's always had value. And I appreciate you contributing to our community as you have for this amount of time, and wish you happy holidays, you and your family and associates and friends. And I hope you have a great 2024, Peter Bookvar.
Thank you, Dale. I appreciate having me on. I always do. I'm always grateful for the opportunity, and always fun chatting.
All right. Peter Bookvar, follow Peter and sign up for his letter, and, keep in touch in 2024 with what Peter's doing. And I think I had it up here, but just go to @pbookvar on X and you could get to it. So thanks,
Thank you,
Peter.
Dale.
Happy New Year too, bro.
Happy New Year. Happy holidays.
All right, so that's a wrap, everyone. Hope you enjoyed Peter. Likes the emerging markets, right? Bearish a dollar. Metals look good. The masochists and miners may have their day. And I'll see everyone tomorrow, TGIF, for the end of the week going into the Christmas weekend. And I'll just say, it's gonna be a blue, blue, blue Christmas without you. Don't just count your pips, count your blessings. See everyone tomorrow, okay? You like that, Elvis? All right. See you, Laura, Michael. Good luck today. You're welcome, George.